So the next spread trading strategy we'll talk about are the profit guard stock spreads. And with the profit guard stock spreads, we use the power trend system to select stock trades. And there's two steps involved with the stock selection. First, we determine the price trend of the stock using the 10-month simple moving average. And then we select an entry point using the Keltner channels. And once we enter a directional stock trade, we use the trade management guidelines to manage our stock trade. We exit losing trades quickly by using a 7 to 10% stop loss from our entry price, and we don't exit trades with a small profit. If we have a 10 to 15% or higher profit on a stock trade, then we leg into either a covered call or a profit guard spread. So again, depending on the premium of the underlying stock, if the underlying stock has a rich premium, which we'll be selling, then we will initiate a covered call. And if the stock has low premiums, then we'll initiate a profit guard spread to help protect profits. And again, we normally leg into profit guard stock spreads on stocks with low premiums, and we'll leg into covered calls for stocks with rich premiums. And again, we can use that example. A rich option premium would be a premium that has a high time value in proportion to the stock price. So Facebook has a 4% time premium for the 1-month option. The utilities ETF only has a 1.3% time value of the ETF price. So you can see the utilities ETF would be considered a low premium, and the Facebook would be considered a high premium. So if you have a profit in a directional stock trade, you would leg into a profit guard spread by purchasing an at-the-money put option. Put options profit as the price of the underlying stock declines. And if you have a winning stock trade, purchasing a put option provides a profit guard that helps protect you against loss for your stock investment in case the stock declines in price. And at the same time, there's no limit on the upside potential of your stock if the stock continues to increase in price. And this, by purchasing that put option, we're going to lower our stock trading risk, and this can even guarantee that your stock trade will be profitable. And just like the profit guard option spreads, once you buy the put protection for your stock trade, then you can forget about that trade until option expiration. There's no need to monitor the markets or set protective stocks. The profit guard stock spreads are also known as married puts, and the risk is limited to the cost of the spread. And these profit guard stock spreads, just like the option spreads, can profit if the price of the stock goes up or down. And profiting when your stock is up, flat, or down will increase your percentage of winning trades compared to directional stock trades. And this percentage, this higher percentage of winning trades can make you a successful trader. So let's look at an example of a profit guard stock spread. And the way the profit guard stock spread is set up is you purchase 100 shares of stock, and then you purchase an at-the-money put option. And the spread can be initiated simultaneously, or you can leg into the spread if you have a profit for your stock trade. And these can be traded in most retirement accounts. So by purchasing that put option, you limit your risk, and the put option acts as a floor for the value of the stock. So if you buy a stock and you purchase a 55 strike put option, then the value of your stock can't go below 55. So just keep that in mind. If you own a stock and you purchase a 55 strike put option, the value of the stock can't go below 55 with that put protection. So let's look at an example. Boeing was on a power trend buy signal and was trading below the upper Keltner channel. So our brokerage account shows we bought 1,300 shares of Boeing stock at $217.40. So Boeing moved up in price after our 217 entry and was trading around 340. So we had a profit for our stock trade. We had a protective put for our Boeing trade that was about to expire. So we rolled over our put into a new profit guard spread, and our brokerage account shows that we bought to open 13 of the 340 strike puts, and we paid $17.59. So this is an example of we purchased the stock at 217. We had a profit in the stock, so we purchased put protection. We were coming up on expiration for that put, and we purchased a new put and entered a new profit guard spread that expired in about 3 months. So again, our cost basis for the stock was 217. Purchased the put for 17.59. So the profit guard spread allowed us to lock in profits for the trade, and at the same time did not limit our upside if Boeing continued to move up in price. And we have a calculator for the married puts, also known as the profit guard stock strategy. So we have a calculator for that. So we can see cost basis for Boeing 217. We purchased the 340 strike put at 17.59, and we can see that if Boeing stock was flat at option expiration, we had a 44.7% return and a $10,500 profit for the spread. So with Boeing trading around 340, we had a 45% return in this trade, and we don't have to worry about placing any protective stops once we purchase that put option for protection, and that allows us to ride out volatile markets or market corrections, and we don't have to worry about the trade until option expiration. So in this example, purchasing the put option allows us to lock in a guaranteed profit of 44%, and you can see if the stock moves up in price, if it gets up to 380, we'd have a 61% return. If it gets up to 430, we'd have an 85% return. So it doesn't limit the return on the stock by purchasing the put option. So locking in that guaranteed return of 44% demonstrates the low-risk nature of these profit guard stock spreads. And the spread will produce profits despite any severe corrections or wild price swings in Boeing. And again, you can, once you purchase that put, then you don't have to look at the trade until option expiration. Here's another example. This is for UDOW. That's the 3 times leveraged Dow 30 ETF. It was on a power trend buy signal and was trading below the upper Keltner channel. So we purchased 5,400 shares of UDOW at $47.97, and it moved up in price and was trading around 115. So we had a profit for the trade. We already had a protective put in place, but that was expiring. So we rolled that over and we purchased the 115 strike put at 842 to create a new profit guard stock spread. So again, we purchased 5,400 shares. The cost basis was $47.97, and we purchased 54 of the 115 strike puts at 842, and that allows us to lock in a profit of 103% if the stock was flat at option expiration. So if UDOW was flat, we'd have a $5,800 profit, 103% return, and with UDOW trading around 115, we had a 104% return for the trade. So once we bought that put protection, we don't have to worry about protective stops or big down moves in the underlying stock or ETF, in this case the UDOW. So our guaranteed profit with this trade, even if the ETF declined severely, our guaranteed profit was 103%. Okay, and here's a snapshot of that portfolio again, where we had a $901,000 open trade profit. And what I did is I circled the profit guard stock spreads here. We had one for Boeing, we had one for the Internet ETF, we had one for the Chinese Internet ETF, and for the Dow. So these trades were circled here, and the other trades, of course, are the profit guard option spreads. So we trade both types of spreads in our retirement account. And we also have a trading service that makes trade recommendations for the profit guard stock spreads, and email alerts are sent out to the members with instructions on entering a new trade or exiting an existing trade. And as of last night, our total profit in the portfolio was $82,000, and we had an average profit of 174%. And this 174%, that's a pretty high rate of return, but what we do is we roll over these spreads when we get close to option expiration. So if the stock or ETF is still on a power trend buy signal, then we'll roll over the put option into a new put option, and after time, those profits can really build up. So you can see on some of these positions, our cost basis was next to zero because of rolling over the profits at option expiration. So that's how we wound up with such a high average return. That's from the rolling over options, as I mentioned earlier, reduces the cost basis of the new trade and allows you to compound your returns. So if you want more information on the profit guard stock strategy, you can just log on to chuckhughesic.com and click the trade results page, and you'll get updates on these various strategies. Or you can call Brad at his toll-free number if you're interested in the service.